So we have three things going on with mortgages, right? Number one, Fannie Mae, Freddie Mac just announced their loan limits are going to be higher. Number two, we have jumbo loans are now going to be higher. So we'll talk about that. And then three, interest rates. Everybody's talking interest rates going up. I think interest rates are going to go down, but we'll talk about that. Anyway, go ahead.
Yeah, so I mean, the loan limits, the Fannie Freddie Mac loan limit going up was great. Actually, it's the biggest increase that we've seen, and I think that's going to allow. I think it's really in line with what we've been seeing with the price increases, and it's going to allow more people to purchase homes and be in the market versus either not being able to because they can't meet the harder jumbo loan guidelines or the first and second lien guidelines. And so with the lower down payment requirements, lower credit score requirements, and lower reserve requirements, I don't think a lot of people understand that there's different types of jumbo loans, right? But there's some out there that require 36 months of reserves. And so you could be an excellent borrower, like great credit, income, everything, and then that's what counts you out. So I think that even though and we can get into this later, like some people are saying, oh no, it's bad that these limits are going up. I think that it's a good thing because it's going to allow more people to buy that weren't able to because they just weren't able to get that jumbo loan. So now they can get it with conventional. As far as like the rates themselves, I mean, so right now, I think the main news too that I want to point out is the inflation piece, right? So Powell came out and it's not transitory inflation anymore. It's like,
oh, shocker. We could have all.
I know, right? And so now he's admitted like deflation it's hotter than we thought and it's a bigger problem than they originally thought. And so now we're like keeping eyes on the December 15th Fed meeting because they want to see if they're going to speed up tapering because the whole way to combat the inflation problem is to finally raise the federal funds rate. And so like and the only way they can do that is speed up the tapering first.
So what does that mean though? If the Fed rate raises, what does that actually mean for interest rates? Sorry, for the person that doesn't know in the room.
Yeah, sure. So a lot of people get the federal fund rate confused directly with, mortgage interest rates. So the federal fund rate is something it's not directly tied. It will have it could cause like an increase in mortgage rates just because, and I'll get into that because of how it ties together. But really with the federal fund rate increases, you're going to really see that more directly with like direct consumer debt, like your like a car loan, like credit cards, things like that. And you're not really going to be like, oh, the federal fund rate increases. And so now mortgage rates are going to increase a whole point. It's not that direct because it has more to do with the buying and selling of bonds and treasuries. And it's and by increasing the federal fund rate, the government is hoping to decrease the economy.
So we're looking for December 15th. But so if they say that, so we are anticipating rates to increase is what you're saying.
Yeah. Possibly. So what I'm saying is my projection for 2022, I think that's kind of where we're getting at, right? So my projection for 2022 is that we are going to see a gradual increase in rates. I think by the end of 2022, we're probably going to be somewhere in like the like high threes, like high threes, maybe low fours, just depending on where your credit is and what type of loan product we're looking at, what type of property we're looking at. Just because with inflation, whenever there's an inflation issue and they're trying to stabilize the economy, like you're going to have an increase in rate because the whole goal is to help slow down the economy to help combat the inflation problem, to help combat the supply chain problem. That's not what people want. That's not what people want to hear. But I mean, I see, unless like something happens with the variant that causes us to shut down again or something like that, then that would cause a decrease, right? That would cause rates to go back down. That's kind of like the X factor. But besides that, right now, rates are projected to probably be the same towards the beginning, first and second quarter, and slowly increase, and probably, I think, mid to high threes by the end of the year.
Mid to high threes. So
do you feel like once they start rising, they'll never be back at this point again? Do you have that like feeling in your gut?
So obviously I don't have a crystal ball, right? I guess everyone says that, but I feel that the insane lows that we saw, like I was able to lock in people at like 1.9, 1.85%, like in a loan, which is nuts. I don't know if we'll ever see that again. I really don't, because look at what had to happen for us to get there, right? And I don't think any of us want that to happen again. But I can never say never, but it's highly unlikely, in my opinion, unless something else happens, that we'll get back down to those low of lows.
Share your screen again, because you actually had some really great slides that you were showing before. For those that are saying that interest rates raising is going to cause the market to crash, that the amount of people, we're losing people in the world. So that means that we're going to have less people to buy in the future. So that's going to make the market crash. You were showing some stats that kind of went against that. So I'm curious if you could bring that back up. Here we go.
Yeah, sure. So, this was the loan limits.
Yeah. So to answer the question, what are the loan limits for conforming an FHA? You have them right there.
Yeah. So if you're interested in this, you can find this anywhere. For Austin surrounding area, it's for one unit, it's 647,200. So that's what you would be looking at there. And then
what credit score do you need to be able to lock in at 2%? Like a 10,000 credit score?
If you want to lock in, you can pay for that. I mean, you can still pay to get a 2% rate. It's not going to be pretty, but and it depends. Well, it really depends on what term we're talking about as well. If we're talking about, like a 15-year, then a 2% is still pretty reasonable. Like it might be like cost you a little bit in points. Yesterday I quoted someone and it was like a 2.25. So it's really not that bad still. But if you're talking about a 30-year, it's not worth it. Like, you're going to be spending so much money. It's just not worth it. Are
refis slowing down?
Yes, refis are definitely slowing down. I feel, and I've been telling people this for a while now, like if you were ever still on the fence of refinancing, you need to take advantage of it now. And I think the biggest advantage right now are those folks that have seen such big appreciations in their home and have so much equity, because this is probably the cheapest time that you'll ever be able to borrow money and borrow the equity from your home before rates go up even more. And so because this last year, people saw 18% increase. Some people saw 20% appreciation in their homes, and that's huge. So what I've seen now is I do have refinance clients that are doing cash out refinances to pay off all their high interest debt, to convert from like an FHA to a conventional, get rid of PMI, those types of things, where it still makes sense for them to do. But it's going to, as rates continue to increase, it might not make as much sense for them. So if you are on the fence to do that, I recommend talking to someone now while rates are still lower, personally.
I love this chart.
Yeah, so this is the explosive growth chart. So I know, like, when I was on last time before, I was saying, hey, like the average first-time home buyer is 33 years old, okay? And so this goes into, these are the birth rates. So this is the number of U.S. births by year and generation, and this is where we're at. So you can see that over like the next like 3 years, we have an increase, like a pretty large increase. So, I mean, people keep saying like, no, it's going to be like these they keep bringing 2008 in, which it's not, to me, it's not even comparable to 2008. I think that's a ridiculous comparison, but also it's so, because it goes to supply and demand. And I have this other, so to kind of put it, let me see. Okay, here. So inventory versus demand. So we don't have the end of 2021 numbers. So this is based off 2020 numbers. Okay. So this is the percentage of inventory versus the demand in the year. Okay. And so in 2007, before 2028, thanks, Master Jedi. Okay, so in 2007, you can see that we had a lot of inventory. We had more inventory than demand. That was part of the problem. But now, for the 2020 numbers, we had only 1.2 million of inventory for over 12 million households. So there's no way like we've even met that, and we're still deficient. And I was in a call this morning, and the projected numbers for 2021 is we're still 4.4 million behind in inventory for the year. So it's just, we're not there. If we had excess inventory, then yes, that could be a problem. We could maybe see some similarities there, but it's just, the inventory is not there, and then we have more people in the market to buy. So how could we be in a bad, how could we slow down? Like I think the biggest problem is, how are we going to get more houses out there for people to buy?
Thanks for watching this short of the REALMigos podcast. For more live streams, hit here. For more clips, hit here. We'll catch you on the next one.